This is In the Final Analysis. I'm Jim Yockey. Thank you for tuning in this week. Really, I wanted to talk a little bit about the Federal Reserve and what actually the Federal Reserve does with the tools that they have. Essentially, the Federal Reserve has three tools that they can use in order to affect change in the economy. First, they have the ability to pull liquidity out of the marketplace. In other words, the cash that's in the economy that fuels the speed and the growth of our economy. So when they want to pull cash out and slow things down, they will sell their bonds into the economy, whatever bonds that they hold, thus receiving the money out of the economy, which they put back into their reserves. Really, this is a little like putting a hose into your gas tank and sucking out some of the fuel. The more fuel that you pull out, the vehicle is not going to go as far and perhaps not as fast either. So it's siphoning cash out of the economy, which slows the economy. The second thing that they actually do is to raise interest rates. But these are not the ordinary interest rates that you and I think of automatically. In fact, banks borrow from other banks. So let's say you have a bank and you want to make a big loan to a real estate developer or whatever, but you can't do that because you're tier one capital, all of the assets of the bank, which dictate how much money you can actually loan out at any moment in time. You don't really have enough in that bucket or the reserves that you have with the Federal Reserve. So what you can do is go out and borrow from another bank, or indeed you can borrow from the Federal Reserve as well. And the interest rates that the Fed sets are those interest rates that you'll have to pay for that transaction, allowing you to make the loan to the developer. So banks generally, if the interest rates are low, 2, 3%, something like that, they'll go ahead and borrow the money from another bank or the Federal Reserve and make the loan. But if interest rates get too high, 4, 5, 6%, then they're reluctant to make those loans. So as a matter of course, the Federal Reserve has choked off some of the credit that is available in the marketplace, thus slowing the economy. The third element is that the consequence of all of this, taking currency, liquidity out of the marketplace, raising interest rates that cuts off credit, the net effect of this is unemployment. We run into a situation where they're still going to dry up the amount of liquidity and purchasing in the marketplace to slow the economy so that inflation comes down, and that is going to hurt. Even the Federal Reserve admitted it's going to be a little painful. I suppose a little depends on who you are and where you are in the economy. But the fact remains, as an investor, there are going to be consequences for that as well. Because as you see the economy slowing, then profitability for corporations is also going to slow. If companies are slowing, they're not going to make as much money. Therefore, their stock price is probably going to be reduced. We have this pain coming. We're not quite into the significant part of all of it, but I expect over the next few months, it's going to get worse before it gets better. So hang on to your hat. Be careful, be cautious, be defensive. In the final analysis, if you need help, you know where we are. wisdomchoice.net. Thanks for tuning to the final analysis. We try to keep you informed. Be sure that you're on the email list and call us if you have any questions whatsoever.